Hello, everyone, and welcome to our webinar. I'm Jennifer Burnett, the Director of Fiscal and Economic Development Policy here at the Council of State Governments. We are excited to be collaborating today with the Griffith Insurance Education Foundation on this webinar, which is the first in a four-part series taking place on Thursdays at 2 o'clock Eastern Time throughout October. Our series is designed to provide policymakers at the state level information on risk management and insurance fundamentals through the lens of critical and emerging issues. We will take questions from the audience at the end of this webinar, which you can type into the questions box on the side of your screen. Also, this webinar is being recorded and will be available, along with the PowerPoint slides, on CSG's Knowledge Center website next week. With that, I'm going to turn it over to our moderator, Frank Paul Tomasello of the Griffith Education Foundation. Frank serves as the Program Director for Public Policymaker Education at Griffith, and he's going to provide us some background on today's webinar's facilitator. Frank?
Thank you, Jennifer. It's a pleasure to collaborate with CSG on this non-advocative, nonpartisan program series. Both the Griffith Foundation and CSG share similar missions, which include a commitment to an unbiased academic approach to programming, and it's that focus that's at the heart of our webinar series. This afternoon, our speaker is Dr. Conrad Ciccotello. Dr. Ciccotello is Associate Professor and Director of Wealth Management Programs in the Robinson College of Business at Georgia State University. And he serves as the Executive Director of the Huebner Foundation, whose mission is to advance university-level risk management and insurance scholarship and learning. Dr. Ciccotello is a graduate of Suffolk Law School, a member of the Pennsylvania and Supreme Court bars, and in 1993, he completed his dissertation on master limited partnerships and earned his PhD in finance at the Pennsylvania State University. To learn more about his background, his experience, academic interests, you may visit the J. Mac Robinson College of Business website at robinson.gsu.edu to view his profile. Before turning things over to Dr. Ciccotello, let me take a moment to let our webinar participants know that you've each been given complimentary access to self-paced online learning materials that coincide with the topics covered today by Dr. Ciccotello. You'll receive an email message from the Griffith Foundation with login information along with a username and password. You may use that information to access these materials. And we hope that you'll refer back to the materials following the program and as needed. They're intended to serve as a complimentary resource for you. Without any further ado, let me welcome Dr. Ciccotello to the microphone. We thank you for joining us today.
Thank you, Frank. I want to thank everyone who's joined us today on the webinar, and certainly Griffith and the Council of State Governments for putting this together. It's my privilege to be able to bring you this first in a four-part series on risk management insurance, today focusing on fundamentals with an emphasis on applications to sort of bring these ideas to life. Just a moment, Frank had introduced me as Executive Director of the Huebner Foundation. I think to recognize Dr. Huebner is something I always like to do. Professor Huebner was, I think he's widely considered to be the father of insurance economics education. He was at the Wharton School where the foundation was for 70 years before it came to Georgia State in 2012. And Professor Huebner believed that risk management insurance education was critical for households and society. And with that backdrop, I want to start really by looking at slide 3 and emphasizing this idea that insurance is about covered losses. So I direct a program here that prepares people to be financial advisors. And if you think about a loss in the context of a household, I mean, and just view it through the lens of, well, how many households finances could withstand a significant loss? We hear these statistics about, most households only have, 1 or 2 months in liquid assets. So if you have an extreme negative shock to either your income or a positive shock to your expenses, how are you going to manage that? And so we have this risk and insurance function, which I think central to household financial health. And that function is a complex one. I mean, I'm a student of both law and economics, and I find it fascinating, as I think people who are legislators or regulators would as well, that this is an insurance function is often spans public and private entities, as we're now seeing in areas like health and flood insurance. It's a heavily regulated area. These are complex contracts, but they're vitally important, I think, for not only households, but for society sort of well-functioning economics. So turning to the icebreaker slide on number 4, I mean, as I just think right now, if you just scan these healthcare, homeowners, workers' comp, and auto insurance, just think of the contemporary issues that we have. In healthcare insurance, this move towards high deductible health plans where a household might have to bear, $3,000, $5,000 worth of out-of-pocket costs before they would, have any coverage in their health insurance. I mean, how is that going to work going forward? Well, maybe it would be good because people would make an effort, to be healthier because they had some quote-unquote skin in the game. Homeowners insurance, you could think about what's going on in South Carolina right now and the issue of flooding and, what type of coverages there are. Well, normally homeowners insurance only covers, as they say, falling water. It can't be on the ground and coming up. That's flood insurance if it's on the ground and coming up, and that's a national flood insurance program. So this is a critical distinction. It would be nice to recognize beforehand. Auto insurance, just think about the incredibly challenging issues with someone who's struggling to understand the difference between liability insurance for their mistakes and what would happen if an under or uninsured person hit them, and often confused, and people not realizing that they are exposed because nationwide 1 in 8 drivers has no auto insurance. It's estimated, in some states it's as high as 1 in 4. So what most of us do is drive a car, and maybe some of us drive it without this recognition that they may have exposure to being hit by somebody else through no fault of their own and have a loss which is not covered by insurance. So if you turn to slide 5, what we try to do in this sort of intro block and the latter lectures in this series get into more depth in the types of things we're going to talk today about that cross sort of personal lines of insurance and property and specific regulation and legislative themes. We sort of anchored this sort of beginning block in this idea of the modern information society. We now have this proposition of insurance, of sort of getting indemnified or covered, if you will, for losses. But we're in a world that's just dramatically changing, and I think it's interesting to look at these questions of insurance through this modern technological lens. I mean, think about what having a smart home or smart appliances might do to the provision for homeowners insurance. I mean, something smart enough to shut off an appliance before it burns the house down. Something with the capability of spotting and alarming against, a threat of theft that, that's just much more sophisticated than it's ever been before. And it's not only property or liability type issues. I now think of all the interesting new challenges and opportunities in healthcare. You read about group plans that create incentives. So you wear a Fitbit or some device, and if you walk a certain number of steps, you can have reduced premiums. I think about auto insurance, the idea that you would allow sensors to be put in your car that would determine how aggressively you drive and how that might affect your premiums. I think about going online and writing things, blogging, if you will, and potentially defaming somebody, or even something as simple and potentially dangerous as making posts on Facebook. And potentially having that exposed to everyone in the galaxy. These technological advances create tremendous opportunities and challenges, I think, if you're looking at it through a regulator or a legislator's lens, regarding a number of issues like, well, should all this data be allowed to be used by insurance companies? What about the privacy issues in even collecting it? What about if it creates some discrimination in pricing or exclusions even of certain people from various types of insurance? These are all very interesting emerging issues that I really believe that this sequence of webinars will help to shed light on for that person who is thinking about the issues involved for their constituents here at the state level. So if you look at slide 6, again, I'm not going to read the slides word for word. I want to focus on a few key concepts. And in this slide, the word that's interesting in terms of understanding foundations of insurance is transferring. So you can make a decision to transfer financial consequences. Well, what if you're not transferring those consequences? Well, you're retaining those consequences. And so this is going to be a fundamental concept because there's going to be, and I think economics would drive this decision as well as your tolerance for risk, some risks that you retain. And there's going to be some risks, and I would say this, as somebody who trains advisors, that you should transfer, that you're really unable to retain. And we're going to talk about that theme today in an introductory framework as we go through this block. So if you look at slide 7, again, this is my background now, very interested in households. What's the benefit of insurance? Well, it's back to this idea that it helps you out after a bad event. And in the economics of income, what we think about is households need to smooth income. You need to eat in every state of the world. You need to be able to cool your house in the Northeast in the winter, or heat your house in the Northeast in the winter. Cool your house in the South. Almost 12 months a year. Some parts of the South. There's just some things you have to have for your well-being, and negative shocks are not something that many houses can tolerate. So that's a risk they're going to be looking to transfer. And if you go to slide 8, you see the bigger picture here. This household health, constituent health, going down the individual person level, if you will, builds up into societal health and a robust economy because insurance facilitates the smoothing and the spreading of risks, which allows things like credit to exist and allows businesses to function. You can think of small businesses very much as extensions of households. And insurance has a critical role to play in society, and of course, as does the regulation of it. So if you turn to slide 9, you begin to see one of the behavioral challenges in insurance. The costs are, most of us are engaged in one type of insurance market or another. If we drive, we have to be. But insurance has this dynamic of you pay up front, okay, and that's a premium. It's also money you can't use for something else. Now, if I just think of a behavioral lens here, if I got to pay first, and the only time I'm going to ever get any money is if something bad has happened. There's frictions here, as we would say in economics, I'm not going to be inclined to want to pay, and I really don't want to think about bad things happening. And so this friction, if you will, can lead to underinsurance, can lead to exposures, can lead to failing to transfer risks, which the household really shouldn't be retaining. If you go over onto the other side, go down to slide 10, if you think about the insurance company, the individual household business is trading in risk with the insurance company. And now that company has to, operate. They have to operate efficiently, and they have to operate legally. And in the insurance world, they face some particular challenges. So I've seen papers on auto insurance that suggest, for example, that up to a quarter of the claims are fraudulent. So they have to discern which are legitimate claims and illegitimate claims. And if you think about the times when you have close customer service interactions with an insurance company, by definition, they occur just after something bad happens. So you're usually not in the best frame of mind. Somebody passed away, somebody was disabled, there was an auto accident, your house had a fire. and then you're unhappy when the insurance company starts asking questions. Well, there's a high fraud potential, and questions, need to be asked. But it's still very difficult from a customer service perspective. And we also have these issues, and we're going to talk more about them later, about carelessness and indifference. So maybe after I have insurance, I'm just not as careful. I mean, I think about that every time that I'm almost run off the road by somebody in a large SUV who's more interested in their cell phone conversation or who's texting while hurdling that vehicle down the highway at 70 miles an hour, 10 feet from the bumper in front of them. And there's also a lot of litigation in insurance. I mean, and some of the litigation arguably is frivolous, but it drives up costs. So it's an interesting bargain that you enter here when you start to think about trading in risk. So if you look at slide 11, I'm not going to dwell on these, but fundamentally insurance is based on some ideas that are tied really to this notion of actuarial soundness. Indemnification means you shouldn't get back money in excess of what you've lost. I mean, if we allow people to, in some sense, profit from having insurance. So if my house is insured for twice what it's worth to rebuild the house, I'm going to get an upgrade to my house if it burns down. Well, you know what? I could start smoking in bed. I mean, I've got an incentive to have a claim. So indemnification is really, really important. Law of large numbers is important. I'm really sort of moving here through 12 and on to 13. It really, really helps the pricing and the actuarial soundness of insurance to have a lot of data. And, I'm fortunate here to work with some of the best actuaries in the world. And you could think of like life insurance. People have been dying for a long time. There's plenty of data. And the industry and the actuaries are very good at pricing death. I mean, so this is normally something that really underpins insurance. But then you could also think about some examples where maybe you only have one or two items. That, this would not be a typical primary carrier, but, an insurer like Lloyd's might insure some, athlete's arm, a famous pitcher's arm, or oil tankers. They have a different challenge. But for most of what exists in the industry, we have a lot of data, and we can use that data to get very reasonable prices. And again, this idea of insurable interest is the third notion here on slide 14. Is, we would think about situations where perhaps somebody, took out a large life insurance policy on somebody else. For example, I'm a college professor. I don't need $10 million worth of insurance. So, if my spouse took out $10 million worth of insurance on me, well, maybe we start having a lot more bacon for breakfast and other stuff like that. That's an insurable interest type question. None of that happens, by the way. We eat cereal for breakfast. So these three ideas of indemnity, large numbers, and insurable interests really underlie actuarially sort of the foundations of insurance. If you turn to slide 15, you get into the economics. I'm in a department here where we have economists and actuaries and lawyers all together, and the idea of this group is to be a risk think tank. You really, to understand insurance well, it really takes all three disciplines. And the economics of insurance are fascinating. If you think about on slide 16, for example, how do we think about what affects the price and how markets work in insurance? I talk about this a lot in my introductory graduate classes. I try to get people thinking about organizing risks in their mind, and maybe at one end of the spectrum, think about a risk that I'm going to use an adjective here that you might not think of as appropriate, but a clean risk. So a clean risk. Well, okay, clean is dead or alive. That's about as simple as it gets. Now you can even complicate that. What if somebody is lost? in some sort of a tragic accident like an airliner goes down. Now that could complicate things, but normally dead and alive is pretty clear. And so the event which triggers the payment of the claim in life insurance, often straightforward. Well, if you start turning this dial and making the risk muddier or less clear, just turn it to disability. Well, there's more than one way to be disabled in terms of contractual standards. Often in private disability insurance, group disability insurance, disability would be inability to do your own job. And maybe inability to do any job for which you're qualified after, for example, your inability to do your own job for 2 years. Well, Social Security disability has a different take on that. In some sense, it's a tougher standard. It's unable to do any substantial gainful employment. So there's multiple ways to be disabled. And also, if you think about moving from life to disability, you start to bring in these other risks. So for, faking being dead, I guess, can be done, kind of hard, but what about disability? Well, is it possible that somebody could claim to be disabled and not be disabled? Well, I think we're all aware of stories where that has occurred. Sometimes that ends up on a late night, news show, and sometimes it's revealed in a spectacular fashion. I remember the story about a gentleman who was allegedly totally disabled who was filmed at a wedding reception, jumping up and down to Van Halen's Jump. Well, that makes us all angry to the extent where we are the insurance company as citizens of the United States, because Social Security is all of us and we provide insurance. If people are collecting when they shouldn't be collecting, that's hurting us, the company. So the risks, as you move from life to disability, the pricing gets trickier. And as you move from disability to health, well, how many ways are there to collect under health insurance? So when there were maybe only 3 or 4 ways to be disabled, there are hundreds of conditions that would trigger payment under health insurance. Long-term care. Long-term care, another no way as long an underwriting history as life or disability, but a fascinating risk to try to price. Normally priced based on the inability to do a certain number of the activities of daily living, commonly 2. So you can't get out of bed, or you can't feed yourself, you can't go to the bathroom by yourself. So life, disability, health, long-term care, property liability, and professional and commercial, these are all different markets in insurance, and the factors that affect the prices vary. And as the risk gets more complicated or muddier, if you will, the pricing gets trickier to do, and you have to think about it, I think, through 3 lenses. The individual's lens is, look, I want to get the maximum benefit for the least amount of premium cost. The insurance company's lens, which is, all right, we want to be competitive in our marketplace, but we want to have adequate reserves, and so we can pay our claims. And the regulator or legislator who's saying, look, I want this to be a fair contract with proper disclosures. I want the insurance companies to be able to pay their claims, and I want a healthy economy. I want this insurance function to be able to support a healthy economy. So if you turn to slide 17, you'll see some of the language which I've been talking about in terms of applications. So if you think about the economics of insurance, there's a concept known as adverse selection, which is really this idea that's spelled out on slide 18. It's the people who need the insurance the most, to have the greatest probability of loss, that are most likely to buy it. Well, this is, pretty sound economics, right? So if I'm almost dead, I want to buy life insurance. Well, yeah, okay. This is why we have underwriting standards. Underwriting allows the pricing, or maybe even the inability to purchase insurance based on certain factors, which we're going to talk about in terms of whether or not they're legal to use, and whether they should be used, whether they're legal or not. And it also brings up a fundamental concept in insurance. It's this idea of separating or pooling. So as I always tell the students, it's like, all right, when do you want to separate from others in terms of purchasing insurance? And when do you want to pool with others? And a classic example of this is, well, if I have group plans at my work, and I have the opportunity to go out into the individual market and purchase insurance, when should I use the group benefit and when should I use the individual benefit? And I think if you were to check on just get a quote, look at the quote, for example, in your group plan, let's just take life insurance, for example, and then look at a private market quote, you could get some idea for what's happening here. So often in group insurance, what the group really does is, certainly I think you have a window when you take a new job to get insured for a certain multiple of your income in life insurance. If you thought of it as, well, my health isn't very good, this is an opportunity to get insured for life by pooling here. That would be a great opportunity. But you could take the counter example, which is, I'm very, very healthy. And if you look at group premiums and you're an extremely healthy individual and compare a group life insurance premium to a private life insurance premium, I think you'll often see is the individual quote you would get as a healthy person for life insurance is much lower. And I often think of gender here as an issue too. So healthy women would be maybe even a bigger differential, because what the group is doing is the group is pooling all the risks of let's just say the company in terms of a group plan at a workplace, whereas the individual you're separating. So you want to separate in terms of being a buyer of insurance whenever you can and whenever you're low risk. Now this can get muddied up when you think about something like disability, where there's a lot of sort of this moral hazard type risk, changing your behavior or becoming indifferent. That would affect pricing, and there it might be better to join the group plan, because if you approach an insurer as an individual and say, I want to purchase disability insurance, they're going to take a really hard look at you. You may still get favorable terms, but the dynamics change. So this idea of adverse selection is an important one to recognize. So if you turn to slide 19, you start to get into what I think is a fascinating area for legislators and regulators. And it's like, okay, well, if we're going to price these risks, what information do we need? What data collection is appropriate here? And for the rulemakers, I mean, what should be allowed? And there's certainly, as you go through this series, you're going to have a whole webinar on legislation and regulation. But here, I just want to kind of introduce some ideas about what's out there. So, even on issues like race, national origin, religion, and gender, there's a wide variety across of whether or not it's prohibited across states. So states vary here, even in some of these terms, these race, national origin, religion type characteristics. It's not all the same. It depends what state you're in. And it creates these interesting questions about, well, okay, what's valid here? What's appropriate to be used? And so I like to think about questions regarding, well, I mean, does a person have any control over this characteristic? So are we looking at, I'll use an example, smoking and life insurance. Well, should the life insurance company be allowed to use the fact that you smoke or don't smoke to price your life insurance? Well, I think most people are aware that most companies do, but I think about it through these two lenses. Does the individual have any control over it? Well, you can choose whether or not you smoke. Now, I realize you could be hooked on smoking, but you still have control over it. Okay, so it sort of gets over that question. Question two is, does smoking have any sort of strong causal relationship with dying earlier? And I think the answer is generally thought to be yes. No, certainly not for every single individual, but there's a strong association or causal link there. So you have something like smoking, generally allowed to be used, and I would say the economists would say appropriate. But then you can move to other characteristics, and this gets more interesting. For example, weight. Okay, do you have control over your weight? Well, yeah, maybe somewhat, but maybe some people don't have it so much. Is weight associated with, premature death or mortality? Well, yes, but maybe it's not as strong as smoking. So as you go through all these characteristics and kind of run them through those two questions, you could start to get a sense as to whether or not, the economics and maybe the law should support a prohibition on those characteristics. If you move to slide 20, you sort of say, well, if adverse selection is kind of on the front end of this bargain, as we want to think about who has a tendency to get in the contract, this moral hazard idea it's a little more of a back end type phenomenon. So what happens, once I have the insurance? I can be dishonest. I can say I'm disabled and I'm not, or I can be careless. I often think about this as, again, with auto insurance, most of us drive. What if we had to settle our accidents by writing somebody a check at the scene? I mean, would people drive any differently? Or would the fact that they have basically transferred most of the risk of their careless behavior to the insurance company affect the way they drive? I certainly think that it matters in how people behave. And one of the ways you could think about this as a buyer of insurance is through this notion of deductibles in this last bullet. A deductible basically says, okay, if I'm at fault in an accident, in an auto context, I'll pay the first, $1,000 to fix my car, $1,000 deductible, or I'll pay the first $500 to fix my car, $500 deductible. The deductible to an economist is a sort of a credible way of telling the insurance company how careful and how good a driver you are. So if you're willing to pay the first $1,000, you're signaling to them you're more careful, everything else the same, than somebody who wants the insurance, who's only willing to pay the first $500. Now, what's really interesting when you price insurance is, well, okay, if I have two identical policies, one has a $500 deductible for collision and another has a $1,000 deductible for collision, what's the difference in premium? Well, I think if you look at it, that you would not be uncommon at all to find that you're spending a couple $100 a year in insurance premiums for that $500 difference in deductible. And I would say as an economist, that starts to get, at one of the problems, in terms of efficient use of insurance. So you're spending a lot of money relative to the benefit. And especially when you think about how some people, I think it's rather chronic actually, based on all the financial plans that I've read from students over 16 years. They tend to carry very low liability coverage and very low deductibles, which means they're spending a lot of their premium dollar on small value items, and they're signaling to the insurance company that they're careless, and they're really not recognizing, I think, what is really important to recognize, which is a liability event in an auto context can be devastating to your finances. So, if I'm on my way home and I hit a doctor coming off a shift change at Grady Hospital in Atlanta and cause $1 million in damage to her, and I have a $50,000 liability limit on my auto insurance, which is the legal limit here, I am in significant financial pressure, and I have a tremendous exposure, which they can try to either attach my assets or garnish my income to satisfy. So turning the page a little bit to actuarial notions, if you look at slide 21, actuarially fair is a concept that's important in insurance, and this is this idea that it's a fair premium in terms of the risk. And it may be that there are prohibitions on using some factors which would go into fairness, But this is the way the actuaries see things: is that we've got the premium is directly proportional to the exposure, and it's actuarially fair. And slide 22 sort of captures that. The sort of alternate construct of fairness is one that's based more, I think, in equity, if you would, for lawyers. It's social equity. So this is really more about people's ability to pay, and less about sort of how we price the risk in a rigorous academic way. So social equity is also an important concept that can certainly come up in a legislative or regulatory context if we have people unable to insure themselves. I mean, do we have policy adequately? Do we have policies to address that? So if you turn to slide 24, you get another item here which is interesting in foundation of insurance, and that's this idea of the timing of the loss. And the way I think about this is it's described in terms of tails. Something that's short-tailed would be, for example, property claims. So, tree fell on my house. Good companies out there. That day. And I have a check. Or, I ran into something and destroyed my bumper. Well, that is settled up within a few days. That's not all insurance losses, however. Some are long-tailed. And this idea of a long-tailed loss is something where it may take years to actually figure out what the loss is going to be. So medical malpractice is a good example, or workers' compensation. I mean, the average med-mal case could take 4 or 5 years. So from a regulatory perspective here, this longer tail losses create more uncertainty, and as I think about the insurance company's ability to pay, do they have adequate reserves? Are they financially, strong? Are they solvent? These long tail losses create more of a risk, if you will, for assessing whether or not that company has the adequate reserves. So turning to page 25. Again, we've been talking about sort of risk management insurance fundamentals. I think this idea of insurable risks, and ideally insurable risks, is one that's important. And again, there's concepts here we've talked about before, using the characteristics which, help price the risk accurately, and, trying, to stay out of markets where you don't have a lot of information, and if you turn to slide 26, this idea of fortuitous comes up, which means that this is a random event. I mean, insurance is not about collecting for stuff that's done on purpose. But this varies again by the type of risk we're considering. So we're insuring lives. I mean, plenty of data. A lot of fortuity. If we're insuring, a tanker or a specific individual for their professional career, this is much different. So ideal risks are the ones that have lots of data, lots of history, and a lot of randomness. Turning again now, let's turn forward, if you will, to slide 28. I want to say a few things about the insurance product. And if you then think about, well, what type of contract do we have here? Briefly on slide 29, I mean, this is, it's an agreement between the insured and the insurer, and it's a promise to pay contingent upon the occurrence of a certain event. And I want to really spend more time thinking about this particular contract and as it's sort of teed up on slide 30. Complexity. Now, if you work and think about financial literacy, and there's a number of interesting studies out there, and many of the findings are quite concerning about low levels of financial literacy amongst consumers. And think about a typical insurance contract, even auto insurance, although you can get much more complicated than auto insurance. People tend not to read long, complex contracts of any kind, but financial ones, I think, in particular. And this brings up this issue of consumer protection. I mean, so should the state step in, given that people are not carefully reading this? And if they should, what should they do and what should they say? And you could think about, like, your auto insurance has a declaration page, which sort of sums up everything in one page, which is a way of sort of reducing people's kind of cost of reading this. So the key stuff's not sprinkled through 30 pages. It's sort of summarized on one page. And, you know, when my son was much younger and in Boy Scouts, I taught the personal management badge. And one of the blocks was on insurance, and I would have to get 14-year-old boys to focus their mind at 8 p.m. at night around auto insurance. And that was a challenging task. But I would bring in a declaration page from an auto insurance policy, and I would say, you know, unless you can tell me what this means, you know, I'm gonna go tell your dad you're not ready to drive a car. And, you know, those boys would get their minds focused, and, you know, and they would figure out what this meant. I mean, they would sort out in their mind what liability was. Okay, this is if I'm at fault. Coverage on the auto, which is okay. You know, this is damage to my auto if I'm at fault. Uninsured and underinsured motorists. Okay, this is when I'm not at fault, but the other person doesn't have enough insurance or any insurance. And they really made a good headway here, but it's just very, very hard. Many consumers go through their entire life struggling with these concepts. So if you then turn to page 31, you begin to bring in these ideas. This is a complex contract, which is difficult for a lot of consumers, and we may end up with a lot of litigation and fighting over whether or not something was covered, not covered, what representations were made. And this is, to some extent, unfortunate because it may lead people to not want to enter the contract in the first place, leaving themselves exposed, or it may lead to, you know, a lot of the use of the courts, which, you know, given the stress on courts, that's not a good outcome either. So if you then go to slide 32, you get this idea that you know, you tend to have the customer service experience at the worst possible time, and that's just, I can't think of another industry where, you know, in terms of financial services, this is sort of set up to be the event is a bad outcome, and that's when you're trying to get money. So that makes it a very, very difficult circumstance. So I'm only a few minutes here from wrapping up and going to questions. I just want to take just to wrap up here and start bringing this to a close, looking at it at really process in insurance. So if you think about slide 33, what we're introducing here is this idea of dealing with exposures, their losses. And slide 34 then goes to, well, what type of techniques are process? I'm a big believer in process, and I think process discipline can take you, a long way in a number of business and personal financial contexts. So slide 35 really has kind of the essence of this here is, I think a good process in thinking about managing risk is to identify the risk, analyze its impact, make a decision about whether you can mitigate it, and then decide whether or not to keep it or transfer it. So I'll go through one which I know is a common mistake. So suppose I'm a young, healthy individual who's a major breadwinner in the family, and I have a couple of young children, and let's suppose my spouse stays at home with the children. Okay, I can identify risk. Well, one risk is I would have a premature death. That's low probability if I'm young and healthy. How would I analyze that risk? Well, I would look at what would happen to my household if my income were gone. And I think the studies that have been published in the U.S. suggest, often there would be a standard of living diminishment, significant standard of living diminishment. Well, can I mitigate this risk? Well, sure, I can eat healthy, I can not do dangerous activities, but I can't eliminate it. I mean, I still have to get in a car and drive around with a lot of distracted people. Other accidents can happen. Do I want to retain that risk? Well, there's no way that our finances at this stage and with this couple that I'm describing, our balance sheet can't. We can't hold this risk to our own balance sheet. We should transfer it, and it's very inexpensive to do. Yet, I think what you see throughout society are issues like, gross underinsurance for life, especially amongst one of the examples I gave you, the asymmetric earner couple. So, the technique here, I think, is an important concept. So I want to then skip over to this last block, which starts on slide 38. Insurance operations are regulated. And, there'll be more about this in this sequence. I'm just going to tee it up here. And we've already talked about this in a number of different ways, but the consumer protection angle here is important on slide 39. Trying to get standardized, easier to read and understand policies and products, controlling market conduct, advertising, which is deceptive, ensuring, that there's a reasonable market for insurance, that people have, choices, they have reasonable prices and competition, is what slide 39 talks about in terms of consumer protection. Solvency regulation really is the other piece, and we mentioned this before. So, on slide 40, it talks about, hey, we have to make sure the insurer can pay the claims. Are they prudently managing the money they have so they can pay claims? So this clearly is at a boundary. The insurance industry exists at a boundary between public and private space, which is quite an intense boundary. I mean, it's one where there's a lot of overlap. So if we look at slide 41, I'm going to bring my comments to a close, and we can go to questions. So I think insurance principles that we talked about today is this idea of transferring risk versus retaining it. And generally, you want to transfer risks that you cannot self-insure or retain. So that's large stuff. Insurance is about setting off or transferring large risks. You retain small risks, I think, given the cost of processing claims and just the economic efficiency. But many people are confused about it, and they end up transferring small risks and retaining large ones. Insurance contracts are complicated, and that is a challenge for legislation and regulation, is try to think about ways to make them simpler without robbing them of their essential meaning. This is in the end, it's not a simple proposition. There are exclusions. There are terms that have to be understood. Insurance is a really unique contract in that you pay up front, you pay your premium, and then you collect only on certain contingencies. Something bad happened. So we have these issues like adverse selection, which is the wrong people tend to want to buy insurance. And then hazards, moral hazards, that you get careless or even fraudulent after you own the insurance. And how is it priced? It's priced by a number of actuarial and economic factors. And those are things which are subject, to laws and regulations. And the timing of claims varies. Some are quick. I got my check to repair my bumper today. Some can take years, which are things like medical malpractice. And this is a highly regulated area, which I think makes it particularly interesting and important for legislators and regulators. So that's going to bring my comments to an end, and I'm certainly happy to take any questions that anyone has.
Conrad, thank you very much. Greatly appreciate your comments. We do have some questions that have been submitted, and want to delve into those in just a moment. Before I do, a couple of quick reminders. Number one, for folks participating, as we mentioned earlier, complimentary access to self-paced online learning materials are available to you, and you'll receive username, password, and access information electronically. So to the extent you want to explore some of these concepts in a bit greater detail or at your own pace, we'd encourage you to do so. So keep your eyes open for some email messaging from Griffith on that front. Second reminder, we have some questions that have been submitted, but if there are those in the audience that have a question or two and you want to send those our way, please feel free to do so. We've got about 10 minutes or so remaining here, and we will be on the lookout. one question submitted here that I'll pose to you. The consumerist perspective on risk is often delivered at the soundbite level, if you will, as a one-size-fits-all rule. An example is never buy whole life insurance. And so our participant writes, does this consumerist perspective dissuade households' engagement with insurance companies and lead perhaps to underinsurance? Dr. Ciccotello, could you comment on that for us?
No, it's a great question because I think there's quite rightly, I mean, and there are a number of high-profile, I call them consumerists, who do wonderful work, and they tend to interact with the public through media, like radio, or the web, and that media, especially I think the radio soundbite or the television soundbite, what's possible to communicate in the window of attention that you have is something very short and direct. Always do this, never do that, is an example. And you think about insurance, the sort of safe harbor for the consumerist is often never. And now, if I had 20 minutes to parse, I'd say, well, if we were talking about whole life insurance, maybe I need whole life insurance if I have illiquid assets in my estate, like I own a small business, or I need cash at death no matter when cash occurs, because that's what a whole life insurance product is for, as opposed to term life insurance. Well, whole life insurance is scary for consumers because it may be sold by somebody who makes a commission, and you can't determine whether or not it's being sold to you because you need it or because the person who's selling it gets a commission. So it's been my concern that there's really the sort of problem side of the kind of shields up around anything related to insurance is that you get less engagement. And this is a challenge. I mean, I think there's also a notion in consumerism that you shouldn't pay or engage, with any sort of intermediary to help you. And it is true, I think the life insurance force, I'm looking at, thinking life insurance, agent force has shrunk dramatically over the decades. And it's challenging that if you're going to say, well, I can't trust anybody to help me, not engaging with anybody about insurance, you again are going to have an underinsurance problem. And life is one area where I think this is manifest now. The law says you have to have auto insurance. Okay, I see a lot of people who make very significant incomes who carry the state minimum amounts of insurance in Georgia. I just think that's a mistake, and maybe a little more engagement, spending a few more premium dollars might save them an exposure which would otherwise wreck their financial life. So that Frank, I think is a take on that. I think good work is done there, but I think on balance, to have some trusted advice is important here because this is, I think, both household and societal health that could be served better, I think, by more adequate provision of insurance.
Thank you very much. We've got just a limited amount of time here, but a couple of other questions. We'll see if we can work through them, or at the very least, I'll pose one to you now, and let's see where it takes us in terms of time. Setting defaults to nudge individuals towards certain financial strategies has become more widespread in recent years. And our participant writes that an example is defaulting employees into retirement plans and into target date investment option if they don't make an investment selection, for example. And I wonder, can you comment on considerations surrounding defaulting individuals into certain types of insurance?
Right. So this movement, this behavioral movement called nudging, has become quite prominent in the last decade or so. Cass Sunstein, who's one of the advisors to the president, is one of the academics who has written on this, and it embeds a pretty powerful notion, which is, all right, well, what if I don't do anything? What happens? There is a default, and default sort of management or nudging people towards certain outcomes has become very prominent as the question made reference to in retirement. So, all right, if I don't do anything, I'm in my employer's retirement plan, as opposed to I have to do something to get in. If I don't do anything, I get the target date plan for my age, as opposed to ending up in company stock or in cash in a money market. The idea has been sort of less, well developed or put into place on the insurance side, but this is really now getting to the same types of questions with regard the state's or society's role, if you will, in helping its constituents or nudging its constituents towards certain outcomes. And I think this politically is a fascinating question, because you may well have sort of leanings here that say, well, we should let people make their own decisions about insurance, but then on the other side you would say, well, if they make poor decisions and they haven't sort of engaged in a reasonable set of laying off risks with a private insurance company, they end up being publicly kind of insured de facto one way or the other. So if I think about it through nudging through an insurance lens, one might go to suggestions like, well, in a group employment a group insurance situation, that I am nudged into the long-term disability plan unless I opt out, as opposed to having to opt in. I notice a large number of people who don't, who have group long-term disability insurance who don't buy it, even though I believe, the premiums are quite reasonable for the folks I'm thinking about who are making, sort of middle income and upper middle income levels. So, Frank, the idea would be that you sort of set some of these defaults on areas where I think they're shown to be significant underinsurance, set those defaults to on, as opposed to off, at the same idea as retirement. And somebody is always free to go in and say, well, no, I don't want that. I have a private plan. Or, what, our situation is such that we can self-insure against those types of things. But the contracts are so dense, and I think the challenge of sort of wading into insurance is so hard that I think it may help, and it may help on the margin in more of the group context where there's some protection. You're not signing somebody up for some private policy that's kind of, not going through the scrutiny of being looked at by the employer or the person or the sponsor of the plan.
Thank you very much, Conrad. We are up against our 3 o'clock closing time, but let's sneak in one quick question here. What 3 takeaways does the webinar provide for legislators or more broadly, public policymakers, if you had to identify 3?
Okay. I think this goes back to Professor Huebner. Insurance is a very important factor to constituent and household financial health. I think it's often overlooked. I think Dr. Huebner was exactly right. It's often, a dense area for individuals, households, for constituents, because it blends these law, actuarial, and economic concepts. So that's one. Number 2, sort of spilling over from that, insurance, risk management insurance is really important to commerce, to I think the economic health of a state, to have a well-functioning insurance market with strongly capitalized and efficiently run insurers and a regulatory and legislative function which interfaces with those. I think that's often overlooked, and it's important to commerce and sort of state economic health. And the third one I think you'll get more into as you go through the series is that states vary widely in how they treat insurance legislation and regulation, and it's a fascinating phenomenon we have in this country, where you have this tremendous amount of state input into insurance. So I'm sure for regulators and legislators, it will be interesting to sort of think through these issues through the lens of their own state and companion states as they go through the program.
Thank you very much, Dr. Conrad Ciccotello, Associate Professor and Director of Wealth Management Programs in the Robinson College of Business at Georgia State University, and also the Executive Director of the Griffith Foundation. It has been a pleasure. We greatly appreciate your sharing your time and expertise with us this afternoon. On behalf of the Griffith Foundation and CSG, we thank you very much, and we thank all of those for attending, and we invite them to participate in the additional programming upcoming. Our next session, October the 15th, next week at this very time, a 2 p.m. Eastern Time start, and we would welcome attendance and participation in that event as well. So thank you very much.
Thank you.
Thank you, Frank, and thank you, Dr. Ciccotello. And that concludes our webinar for today. Like Frank said, I hope you'll join us next week, same time, same place, where we'll hear from Dr. Puser on property and casualty insurance coverage. Hope everybody has a good afternoon, and look forward to seeing everyone next week.